And good evening, everyone. Futures Brizio here. It's late. It's 10:45 p.m. on Wednesday, March 26th. I hope everybody's doing well. And just want to jump in here with a quick video. I'm not going to do any market wrap today just because of the time, but I did want to just cover something regarding the currency indexes. And I've made a couple of videos about this before, but I wanted to concentrate on the Japanese yen and the US dollar index. So, as always, before we get started, make sure you smash that like button, subscribe to the channel. Any questions or comments, leave them down below. All right, so let's just jump right in. So, without rehashing the whole thing, just remember that all Forex pairs are just that. They're two currencies that are paired together. And as I've said in past videos, what you want to try to do is trade a strong one against a weak one. That's the ideal situation. One strong against one weak, and that's where you'll get the most volatility and the most movement. And so, one way you can do that if you wanted to get creative is to split the currency pair in half. So over on the right we have the dollar yen currency pair. This is the regular currency pair that you would trade over here. Okay, over on the left we have the US dollar index, and in the middle we have the Japanese yen index. Okay, which is basically just taking the dollar yen pair and splitting it into its two components, the dollar and the yen. Okay, now I want you to just focus on where you see the blue arrows. Okay, and I just picked a spot, but this will cover the important points. Now, I have a 10 period simple moving average on the currency indexes. That's the yellow line on the dollar and the blue line on the Japanese yen. Obviously, you can use whatever colors you want. It doesn't have to be 10 periods, but you want it to be somewhere in that range. And you can use an exponential if you want. I just like the simple. This is the regular old fashioned simple moving average. Okay? And basically, what you're doing is you want to find places where price makes a decent pullback. In this case, with the dollar underneath the moving average and the Japanese yen above the moving average. Okay, now it could be the opposite, obviously. But again, this is setting you up for a strong versus a weak. Okay, because with the US dollar was trending up, then it pulls back underneath the moving average. The Japanese yen was going down, it pulls back over the moving average. And then at that point, once price basically breaks back above the moving averages, above the moving average for the dollar, below the moving average for the yen, that's when you take your position. In this case, you would be taking dollar yen long. Okay, so this spot in time is also the same exact time on the actual dollar yen pair right here. Okay, so that's the same time. It's March 21st around 8 o'clock in the morning. Okay, so this was last Friday. Okay, so it's right there. This is 9 o'clock. So, obviously you have to be able to, look at the chart and make sure it makes sense. At 8 o'clock, that candle before, the price was still trending down. But on the next candle, it started going back up. But obviously here, at 9 o'clock is when we actually break below the moving average on the yen and break above the moving average on the index. So 9 o'clock is actually the key time here. Okay? And you can see what happened when we did that. Look how much the dollar yen rallied. Okay? And if we measure that in pips, let's take it from the top of this candle right here at 9 o'clock and just run this all the way up. Whoops. Lost my measuring tool. Run this all the way up. If you cut this all the way to the top, it's 209 pips. Okay. Now maybe you don't get it all the way to the top. Maybe you get it to here. I don't know, but it's probably at least 100 pips before you would even think about exiting that trade. Okay. And the whole reason why is because you've got weak against strong. In this case, the dollar is strong, the yen is weak, and you get price then selling down. Okay. So you can sit here and do this really in any time. The key here is that you want to be able to point to an area where there's a weak dollar or one weak, one strong, whether the dollar is strong and the yen is weak or vice versa. Now I want to show you what happens when you have both kind of moving in the same direction. So I'm going to move these arrows. I'm going to move this one down here. Let's swing this around a little bit, actually. Okay, we're going to move this one about right here. And we're going to move this one in the middle. I'm going to move this one over to here. Oops. I just want to show you why you want these to be going in the opposite direction. Okay? Okay, and we're going to move this one on the actual pair right here. Okay? Now, what do we have here? We have both the yen index and the dollar index below their moving averages, now moving up. Okay, right here we have the dollar below moving up, we have the yen below moving up. And look at what happens with the actual currency pair. Okay, we have very sloppy and slow price action from about this level. Price does go up a little bit. So, the dollar is a little bit stronger in this case. And then it comes all the way back down, and then it just kind of, ekes its way up a little bit, and then there's a huge drop. Okay, so on this one compared to the first one, if you got into this one, you probably would have gotten in about something like this. Okay, and then it went up at most here, you would have grabbed about 48 pips, and that would be at most. And then all of a sudden you have this huge candle drop right here. So if you happen to not get out of your position right here, this one candle would have taken you out for a loss. Okay, because again, you don't have the momentum of the market behind you in terms of the currencies having an area where they're trading opposite of each other. Okay, so that's the thing. Let's just scroll back and see if we can find another one here. Let's go to Wednesday, February 19th at 11 o'clock and see if there's anything there. Wednesday, February 19th, right? At 11 o'clock. All right. So that's right there, and now we've got to move this guy over. Move the actual currency pair over. February 19th at 11. Okay, there it is right there. Okay, so what do we have here? So we're going to move this up to here. This is the 19th at 11 o'clock right there. Okay, and then we've got the 19th at 11 o'clock right here. Okay, on the dollar index, and then we've got the February 19th. $11 right there on the Japanese yen. Okay, now it didn't come down too well below the moving average on the yen, but again, look, we've got the dollar above the moving average, so waiting for it to move down. We've got the yen uptrending, pulls back under the moving average and then goes up. And then look at the actual US dollar yen currency pair, okay, at that moment. Okay, and that would have dropped 185 pips in no time there. 2/3 of it was on one single candle. Okay, so I'm not going to beat a dead horse, guys. You can easily go back on your charts and look at these, and again, you can do this on any time frame. Again, I just happen to pick the 1 hour as a nice, easy time frame. Again, if you go down to a really short time frame, you're going to run into a lot of noise and a lot of mixed signals and potentially, areas where you're going to have to, get in and out of trades too quick. So if you want to, smooth it out a little bit and be able to hold the trades at least through one session, I would recommend using at least the 15-minute chart. But, even the 30-minute to the 1 hour, I think, is ideal. And again, what you want to do is you want to just wait for a time where the two currency indexes are going the opposite directions. You're going to wait for price to pull back, preferably above or below the 10 period moving average, but at least to it. In this case, for the yen, it pulled back right to it. It didn't really go under, but it did pull back to it. But you want it to come back into that moving average. And then at that point, you're just going to wait for bullish price action in this case, or bearish price action for the dollar yen in this case. So you're going to wait for on the dollar index for price to break back below the moving average, and wait for the yen to break above, and then that's when you take your short, in this case dollar yen short, and there you go. And then you just basically hold that using market structure or whatever, finding a local supply or demand area or support or resistance area, whatever your exit criteria is. But this is how you want to look for it. And what this does, again, guys, it helps you know before you get into a trade. It helps you be more sure. I mean, you never really know for sure, but it helps you be more sure before you get into the trade. Are these two currencies actually diverging from each other at the time when I'm taking this trade? Because if they're not, if they're going in the same direction, or they haven't pulled back into the moving averages, that there's a very good chance that that trade is either going to be dead in the water, it won't go very far, or it'll be a loss, because you're not playing one strong against one weak. You're not playing currency strength divergence, and that's what this is all about. It's basically currency strength divergence. And the way you can do that is by using the indexes and splitting the pair apart into its two components, and then doing this. Now, I showed you guys this before using the US dollar, the euro, and the Swiss franc. I did that, I think, last week or the week before, and you certainly can do that. I do like the dollar yen too, because it does trend more often than not. I mean, like any pair, it does have its sideways times. But if you look at a US dollar currency, US dollar yen currency chart, you're going to find that for the most part, it trends quite a bit. I would say more so than other pairs. So in that respect, that's why I do like it. But again, you can do this with any pair. You can take any two pairs that you like. That if you have one or two favorite pairs, you can do those. Split them up using the indexes, okay? And then just look for divergences between the two of them, and then take your trade when it's confirmed. You've got divergence going in opposite directions, to either to or through the moving average. And you don't have to use the moving average, but it's a nice tool, and I would say recommend, like I said, a 9 or 10 period simple moving average works just fine. And that's it. And again, I just am using dollar yen here, but you can use any pairs you want. As far as where you get these indexes, this is TradingView. They have them. You probably can get them elsewhere, but obviously TradingView is really nice, just the way you can set your charts up and have these things visible. Now, you may have to have the paid version of TradingView to display multiple charts like this. I'm not sure. You'd have to see depending what you have. But even if you can't put them all on the screen side by side like this, you still should be able to, to still look up the indexes. Just pull one pair. Just like I said, if you have a favorite pair that you like to trade, just do that one, and that's perfectly fine. So, and you won't get a trade every day doing this, especially if you're using higher time frames. Like anything else, like any other system, the higher time frame up you go, the less trades you're going to get. But when you do get them, as long as it meets your criteria in your system, then potentially the better signal that's going to be anyways, and the more profitable and hopefully profitable position that will be. Okay, so you do have to be patient, wait for those setups, but they do happen quite often. I mean, I just pulled two examples off the chart here, and I also showed you one where they're going in the same direction, where the price did not move nearly as much. I mean, it still did move. I think, what was it, like 48 pips? That's still not a bad move, but you can see what happens when they're moving divergently. You're getting like 3 or 4 times, 3, 4, 5 times that much movement, okay? So that's where your risk to reward ratio is really going to be good, okay? Instead of, taking those ones when they're going in the same direction and price is just going to limp along and probably end up reversing on you before you get too far into it. So you want that divergence, opposite directions, and just wait for those pullbacks, and that's all you got to do. Again, you can do this on any time frame. You can use any currency pair. You just need the two indexes side by side to look at and wait for those setups. So depending what you like to trade, you just have to wait for your setup. Okay, but I really do like doing this because I'm not trading a lot of forex. I'm really just trying to stick to one or two forex pairs because as I've said, I'm mostly trying to focus on 2 or 3 futures markets. Now I've cut back on even on that, but I do think that this is an easy way to do it because I don't really have to do a lot of analysis on the actual forex chart. I can just keep an eye on these index charts, and when I see the setup forming, then that's when I'm looking to trade it. I mean, it's pretty much that simple. So, so yeah, that's really about it, guys. I think that this is something you can easily do. It's very mechanical, and like I said, you have a lot of flexibility in terms of what asset, which pairs you want to use and time frames you want to use. Okay, so I'm going to leave it there. I will be back tomorrow, and we'll do a review and maybe even an earlier morning setup on what's going on in the markets, but we'll just leave it there because it is late and I need to go to bed. So all right, guys, have a great night, and we'll talk to you soon.